We have mentioned that the total project cash flows in each time period are going to be the sum of the three different components: the cash flows from the project capital investment, the cash flows from changes in net working capital, and the cash flows from operations. In the last video, we spent quite a bit of time going through capital investments and changes in net working capital. Now we're going to spend time on the one of the three that is the most significant and should and does get the most attention, and that is our cash flow from operations. So let's take a look at our class notes for this. This is on page 3 of our class notes. And we're going to see the cash flow from operations, how to be able to get that. Now, what I'm going to do to begin with is show you what I consider to be the easiest way. And I always like doing things the easiest way if we can. But as we will see, we can't always do things this easy way. This is what I call the top-down approach. And so each year, assuming we're working with years, if we're working with months, it's each month. But I think in our class, we'll just kind of keep it as years. You have to say, from our project, what is our revenue? Okay, revenue is your sales. It's the cash that comes in, and you subtract from that your variable costs, and you subtract from that your fixed costs. Now, sometimes we'll be combining the two. We'll just call them costs, or we'll just call them expenses, or whatever. But hopefully, if you've had some economics classes, you know the difference between variable costs and fixed costs. Variable costs are the costs that go up as you produce more of an item. Such as, for example, your cost of goods sold. Okay, what it costs to actually produce the item. You produce more of them, then that amount of money goes up. Fixed costs are costs that stay the same whether you sell 0 of an item or whether you sell millions of an item. For example, your rent might be a fixed cost. Your overhead, your electric bill, things like that. Whether you produce a lot of widgets or just a few widgets, or whether you sell a lot of widgets or whether you sell a few widgets, your rent is probably going to be staying the same there. So at any rate, sometimes we will differentiate between the two. Sometimes we'll just have it as one item. We'll call it costs or expenses. Now, if we're doing depreciation, then at that point in time, you subtract out the depreciation. Remember, depreciation is not an expense. It is getting to subtract from our revenues an expense that was made earlier when we purchased this capital this capital expenditure, when we made the capital expenditure, but we weren't allowed to subtract it then. So we're subtracting it out now, gradually over the life of the project. So this is not a cash flow in the year that we put it there. It's a cash flow that was already done previously. But it gives us, it reduces our taxable income, which is, we always want to reduce taxes legally and ethically as much as we can here. So we've got our revenue minus our costs minus our depreciation gives us our EBIT. And if you've had an accounting course, you're familiar with that. It stands for earnings before interest and taxes. And that's what we have here. These are our earnings before interest and taxes. We haven't subtracted out any interest. We haven't subtracted out any taxes. Now, as you know, we're not going to be subtracting out interest because we're looking at free cash flow. And free cash flow is money that is available for the bondholders and the stockholders. And interest is what goes to the bondholders. So if we're trying to get at the bottom free cash flow, okay, we can't have already subtracted out the interest that goes to the bondholders. So this is always going to be before interest. It's before taxes because, as you can see, we haven't subtracted out taxes yet. You can also call this taxable income if you want to for what we're doing. So then we're going to subtract out taxes. Now, our taxes are going to be determined by our marginal tax rate multiplied by the taxable income, multiplied by the EBIT. And as I told you before, in our class, in every example I've got that we're going to be doing, our marginal tax rate is going to be 21%. So you take this number right here, okay, and that is earnings that's taxable, and that's going to be taxed at 21%. So the taxes will be 21% of that number. Our net income will then be 79% of the EBIT. So EBIT minus the taxes gives us the net income. Now, if you're in accounting, you're done at this point in time, because that's the number you report to your shareholders. Okay, you maybe divide it by the number of shares outstanding, so you get it an earnings per share. But in finance, because we subtracted depreciation here when it wasn't a cash flow, we need to add it back in here. We needed to subtract it up here so that we would know what we owed in our taxes. But now that we've subtracted out the taxes, we add back in the depreciation. So this gives us our cash flow from operations, or our operating cash flow, if you will, there. Now, if we don't have depreciation, if we are doing capital expenditures, then when we bought the capital good back in the past, we subtracted it from our revenues in the year that we purchased it. So now we're not going to be taking out any depreciation. If we are buying a capital good this year, that's going to be coming out in a cost here. So at any rate, there's no subtraction of depreciation. So it's revenues minus variable costs minus our fixed costs. And again, we may just combine variable and fixed costs. That gives us the EBIT. Subtract out the taxes. That gives us our net income, and our net income is also our cash flow from operations if we are in the regime where we do our capital expenditures in the year that when we can subtract it from our revenue in the year that it is purchased, when we do expensing. So there's an implicit assumption that we have here. Okay, let's take a look at this here. And there's an implicit assumption here, and the implicit assumption is that all of these items have the same level of risk. And here's the reason why that is in there. This cash flow from operations is what ends up going up here, our cash flow from operations, which gets added to these. And most of the time in years 1 through whatever, most of the time, these are going to be zero, and your cash flow from operations is going to be most of your cash flow. That gives us our project cash flow, and the project cash flow is going to be the cash flow that goes here. In other words, if this was in time 3, the project cash flow goes up there as the cash flow at time 3. So there's one number that goes under the cash flow, and that number is getting discounted at this interest rate. Remember, the discount rate needs to reflect the level of risk in the cash flows. So we have to ask ourselves, are these cash flows pretty risky? If so, then we need a bigger discount rate. Are these cash flows very safe? If so, then we need a smaller discount rate. Now, again, we haven't fully defined risk, but let's just think about risk as being a level of uncertainty about something. So if I asked you back at time 0, what are our cash flows going to be at time 5? What I'm asking is, what is going to be the revenues at time 5? What is going to be the variable costs at time 5? What are the fixed costs at time 5? How much is your depreciation at time 5? What are your taxes going to be at time 5? Okay, and so forth. So let's go down here to this, and suppose this is at time 5. And I say, what are your revenues going to be 5 years from now? And you may say, hey, I have no idea. Okay, if 5 years from now, do I know what the revenues are going to be? I say, well, give me your best guess. So maybe you say, well, they could be really high or they could be really low, but here's my best guess, is something in the middle. And then I ask you, what are maybe you're going to be your fixed costs in time 5? And you tell me, now that I know for sure, because my only fixed costs maybe are my rent, and I'm in a 10-year lease, so I know exactly how much my fixed costs are going to be 5 years from now. And then I may ask you, okay, well, how much money are you going to save on your taxes due to depreciation. Do you know what your depreciation is going to be in year 5? And you may say, yeah, I know exactly what my depreciation is going to be in year 5 because I'm buying the piece of equipment in time 0. And once you get out to time 5, you can't unbuy it. So I know exactly what the depreciation is, and therefore I know how much I'm saving on my taxes from that. Well, the point I'm trying to make here is that there is different levels of risk or different levels of certainty in what these cash flows are going to be 5 years out. Okay. Yet you get one, you give all of them, it's going to be your best guess. Okay. One of them could be a very uncertain guess, and some of the others can be very certain what they're going to be, but you end up with one number down here. That number only gets discounted back to time 0 at one discount rate. And the question we have is, should you use a high discount rate representing the fact that the revenues are not very certain, or should you use a lower discount rate reflecting the fact that your fixed costs are pretty certain and your depreciation is pretty certain? And there's not a good answer for that, okay? And as a result, we need to recognize that if we use this top-down approach here, that we are making an implicit assumption that each of these items each of these accounting items there has the same level of risk. And that risk is going to be reflected in the discount rate that we use to discount it back to time 0. So sometimes we don't want to do that. Or sometimes we do want to do it. Sometimes we say, that's fine. Okay, there's just going to be one level of risk for all our cash flows. Nothing wrong with doing that, as long as you realize that that's what you're doing. But sometimes what we're going to do is we're going to say, you know what, I really want to discount our risky cash flows at one cost of capital and discount our less risky cash flows at a lower cost of capital. You can't do that with the top-down approach, okay? Because you only get one number down there. You can only use one discount rate. So there's another way to do it. Here is our other way that we can do it here. What I can do is I can say in each time period, such as let's say time period 5, we were using that as an example, what are my revenues minus my costs? What do I project them to be? I'm combining variable costs and fixed costs here as an example. What do I project my revenues and my cost to be in time 5 times 1 minus my tax rate? That means it's my after-tax revenues minus my costs. Now, if I decide that I want to discount the cash flows from my depreciation tax shield at a lower rate because I know for sure how much taxes I'm going to save in the future, then I can do this for time 5. The amount of my depreciation times the tax rate, that's how much money I'm going to be saving on my taxes in year 5 right there. So the addition of these two, by the way, okay, the addition of these two is going to give me the exact same number right here as I would have gotten up here with this. However, here I've only got one number and I can only use one discount rate. Here what I can do is I can discount this at one rate and I can discount this at a different rate. So I've got it separated out, the two components of my cash flow from operations. I can break it down even further. I can do my after-tax revenues right here, okay? That's my revenues times 1 minus my taxes. 5 years from now, I say, I don't know what the revenues are going to be. Here's my best guess on this, but it's very, very uncertain. So I want to use a high discount rate on this. Maybe my costs, I'm a little bit more sure about what my costs are going to be 5 years from now. So here's my after-tax cost, my projected cost times 1 minus my tax rate. And notice there's a minus sign there because costs are a cash outflow. And so I can use a different discount rate for that if I want to. And then I can even use a third discount rate for my depreciation tax shield, which is going to be how much money I save on my taxes by being able to depreciate. I can say, hey, that is risk-free because I know after I bought the equipment, I know exactly how much I get to depreciate each year. I know what my tax rate is going to be. So this is really, you might call this to be entirely risk-free. This might be very risky. This might be somewhat less risky. Now, the uh, the bad news for you on this is that when you get out into the workforce, you're going to have to figure this out yourself in terms of whether you want to discount everything at the same discount rate or whether you want to discount them at all different discount rates reflecting their level of risk. The good news for you in this class is I will tell you that because I can't have you making the decision on it because you'll all decide different things, and it's kind of difficult to grade there. And there's not a right or wrong way to do it, by the way. It's not like, okay, you need to do it this way or you need to do it that way. That is left up to the financial manager. So we'll be telling you what to do. So I will tell you if there's only one discount rate to use, okay, then hey, you're perfectly fine doing the top-down approach. By the way, if you only have one discount rate to use and you want to do it this way, it'll still work. No problem at all. You just discount this component at one rate, this component at another rate, this component at another rate. But what you can do here is you can use two different discount rates if you want to. Here you can use 3 different discount rates if you want to. That's the advantage of doing it this way. The other advantage of doing it this way is that if your revenues are growing, let's say at 5% per year, and your costs are only growing at 3% per year, it's easier to incorporate that sometimes this way. Sometimes, okay? Sometimes it's still easier. You still might want to do it the top-down approach. Okay, but to emphasize that the depreciation times the tax rate is the depreciation tax shield. That's how much money we save on our taxes in a given year by being able to depreciate. Now, one more thing I want to mention before we go into an example of this, which will be in our next video, is anytime you are saving on your costs, that's the exact same thing as adding revenues, okay? Decrease, because sometimes you will have projects that are not producing something new, but it's a project that maybe you're going to bring in a new piece of equipment that will actually reduce your costs. Works the same way. By the way, if you save on your costs, the IRS doesn't say, wow, congratulations, you get to keep all that money. They're going to say, wow, congratulations, we want some of that cost savings that you put in there. So you're going to get taxed on cost savings just like you get taxed on additional revenue because it'll filter down to your taxable income there. So treat cost-cutting proposals pretty much the same way as you would with a project that gives you additional revenue. Well, we're going to try to incorporate all of these things that we've been going through in the last couple of videos on cash flows into our example that is going to be in the next video.